Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Today we're joined by Nathan Lim from Lonsec. Nathan is the Chief Investment Officer at Lonsec, and we're here to ask him some questions about what's happening in the market and what's ahead for 2024. So thanks for joining us, Nathan.
Great, Martin. Great to be here.
Where do you see the market looking generally? We've had a lot of inflation. What do you think's ahead for the world?
I think inflation is probably the first topic we got to focus on. Inflation is sort of is affecting different parts of the world in different ways. Here in Australia in particular, inflation is looking a lot more persistent. We've had a lot of net migrants moving into the country. We've had issues with the insurance industry passing through higher rate increases. Both of those things are going to take time to work through the system. Now, recently we heard about the government making changes to the migration policy. That on the margin, we suspect that that's going to help on the margin to help take some of that inflation pressure off the markets. But ultimately, we need to see that materially get closer to the RBA's range of 2 to 3% before we're going to start saying that we're all clear on inflation.
It's starting to head down a little bit, but still a long way from where the RBA probably wants it to be.
Yeah, we suspect that's the case. And so as a result of that, just because we see the European central banks already starting to start talking about cutting interest rates, and even now, more recently, the US Federal Reserve doing something similar, the scenario may not be as clear cut here in Australia until we really get to see inflation closer to that 2 to 3% band.
Okay. So we have seen a lot of interest rate rises recently. Do we think we're close to the top of that cycle, more coming? What do you think that looks like in there, as best as that crystal ball looks?
Right now, our view is that the RBA is at the top or very near to the top and closer. I think the fairest way to represent it is that we're much closer to the top than we were, say, 6 months ago.
Okay.
Right? Now, again, this is going to be very much driven on what we see on inflation. As I mentioned earlier, we've seen that the government has taken proactive steps to try to help curb immigration. That will definitely help. We've seen energy prices start to come off the boil. And on top of that, we think that we are starting to see a bit of a slowdown. Clearly a slowdown in the macroeconomic numbers on the world. From an aggregate sort of consumption basis, this would also be positive to help take some of the heat out of inflation. Okay. So when we look at those sort of factors, I think the odds of the RBA doing another rate rise, at this point in time, it's our view that we think they're done.
Okay, cool. And then we were talking about earlier, but there's definitely talk in the market about cutting rates and people are banking those in, and once their rates are cut, their cash flow will be better, but perhaps it's slightly premature. So if we are at the top of the cycle, it doesn't mean we're heading down straight away, though, does it?
Yeah, that's exactly right. You have to remember that what drives the policy rate decision by the RBA is ultimately inflation. I hate to keep bringing it back to this. And you have to really sort of understand what's driving that right now. And as we've seen over the last 12 months, we've had roughly about 1.1 million new people come into this country through students and through net migrants.
Yeah.
That's effectively, we've increased them. That's like 4% of the population that just suddenly appeared out of nowhere. These people all have to live somewhere. And so it takes time for these sort of physical limitations of our economy to sort of catch up. And the big thing that I would be watching is to make sure that we're still building lots of new apartments, lots of new housing, lots of places are opening up to accommodate this natural population growth that we're going through.
Okay. So property markets over the last few years of COVID has definitely kind of shot up drastically. We've seen some pullback or sideways movement. So a lot of our clients own property, maybe looking to buy property, maybe selling some towards their retirement. And obviously different sectors of Australia, but we're based on the Central Coast in New South Wales. So where do you kind of see property as best as possible over the next kind of couple of years at least? Or
that's a bit of a loaded question, so I'm going to try and break it down a little bit.
There's a disclaimer on these, but yeah.
Well, first of all, let's look at it from an investment point of view, right? So let's look at it from a REIT's perspective. You've got commercial, you've got residential, and you've got industrial. I think it's fair to say, due to COVID, that the challenges faced in the commercial/office space are going to be facing some real headwinds for the years to come. There is clearly a move for people to work less from home, but working from home, that's not going away, right? I even look at our own business, where we use hot desks and we only require our staff to be in the office twice a week.
Okay.
So there is definitely going to be a shrinking in demand. It's going to take a long time for the office market to sort of sort itself out. But when you look at other aspects of the property market, industrial is a good example of that. There's still very much need for quality industrial space. So there's definitely a need to be very very, very strategic about where you place your bets within the property market. And that's definitely one area where we would say an active fund manager would definitely help. When you look at the property market in terms of residential, again, I think this is where you have to be incredibly strategic, right? Because the one thing that even myself, I live here in Australia, I live here in Sydney, there's some pockets of the market that never went down. In fact, they continue to rise. There's some, I live in the inner west. Yeah. There are some pockets of the inner west where you still have 5-6% year-on-year price increases, and that has never stopped. Yeah. Whereas other parts of the city, you definitely see a weakness in the property market. So the problem with the residential market, if you want to speak at an aggregate, you kind of have to look at the aggregate factors. So number one, what's happening with rates? I think we got some comfort that we were seeing the end of that rate rise cycle, so that affordability should get a little bit easier. But then when you get to the micro level, not all property prices are created the same. It is very much that old adage, location, location, location. Yeah. If you're an investor, you want to be focusing on where close to public transport, close to amenities that people want to be, and that's really going to be the bigger driver of what happens with your property.
And that's fair because there are sectors where people are buying properties who aren't carrying any debt, so it's not affecting them. Yeah. But also, like in terms of the coastline area, there's a scarcity. We can't just go and build more. Yeah. Say certain new estates and maybe out of suburbs, that kind of stuff, there could be kind of more impact, particularly that mortgage belt, so to speak. But certain areas definitely protected. So I think for a lot of our clients that own property, given that demand as well, rents are still going to keep coming in.
Well, you have to remember that rents have moved up materially, reflecting the fact that there are investment properties out there that are geared. Mm-hmm. And as interest rates have moved higher, their cost of funding has moved higher, and you've seen that pass through to renters through higher rents, right? Now, do we see another leg up for rents? Not really, because the biggest driver of that has been rising rates. And so with this view that rates have sort of peaked, I think a lot of that upward pressure will start to dissipate. Now, whether or not it starts going back the other way, I don't know. I've been living in Australia now for 18 years. I took up citizenship about 14 years ago, and I've never seen prices go backwards for anything, right? And so I kind of have a bad feeling that people are where rents are right now are probably going to be quite sticky.
Yeah, and with that lack of supply still coming in, even if their rent's gone up $100 a week, they look around, everything else has gone up.
What else are you going to do, right? Exactly. It's very difficult. You see it. We continue to build. We definitely build, but are we building fast enough to keep up with demand? There seems to be an imbalance.
Yeah. Okay. Cool. A couple more questions while I've got you, because you're a busy person. Share markets. So we've seen a bit of volatility the last few years. COVID crash, markets have recovered. In the last cycle, say some of the share markets around the world are moving at different rates, the Aussie market versus US and Europe and stuff like that. What are your thoughts, I suppose, what's going to drive those markets and kind of fundamentals wise, are earnings going to be on track for companies? What do you think the share market movements might look like over the coming years?
I think you just touched on the two biggest ones. First is earnings, right? For me, I always come back to earnings. Multiples, so the stock market is a function of earnings and multiples, right? I don't always know what the multiple will do, but if I got visibility that earnings are improving, then at least there's an upward bias in the markets. So let's just go back to the US. The US had forward earnings expectations that were negative for much of 2023. Several months ago, they turned positive. So the direction of travel has changed. Yeah. On an absolute basis, it's still not big numbers, but what you're seeing is that the direction of trend has definitely changed. When you look in Australia, the direction of travel is weaker. Now, a large part of that has to do with commodity prices, right? With iron ore prices sitting at $130, iron ore earnings are great. If we were to assume that iron ore prices stayed at these levels, then you would see upgrades going forward. But there's a natural conservatism in the way that analysts forecast profits in this country, such that they would naturally expect iron ore prices to be weaker going forward. So the earnings outlook for Australia is still very much a big driver of that is what's happening in the commodity space. So then by extension, We then talk about China. What's
Yeah.
going on there? The interesting thing there is that we keep hearing about the doom and gloom in the Chinese market. We're talking about that they overgeared. We're hearing about their property market coming under pressure. But what we are struggling with is that why is iron ore prices still so high? And also, why are we still seeing very strong production numbers on steel? You don't buy iron ore to make steel to just then let it sit on the ground. That's somebody's capital. So it's being consumed. Now, whether that's happening domestically or globally, but whatever the case is, on a ground level basis, while we might hear a lot of doom and gloom in China, a big driver of their economy and a big indicator of that is how they use steel.
Yeah.
And that still looks quite positive. So to be clear, we're not super bullish on China. We are aware that there are policy decisions being made by the government to try to support the property market, to try to inject some stimulus back into the broader economy. We don't know how strong or robust that is, but clearly that policy framework, like the direction of travel, has definitely turned from being restrictive to being supportive. So again, from an Australia perspective, I think there's some optimism that we can be looking forward to, and we'll see how that plays out.
Okay. And so I think probably just thought of as you were talking then, it made me think of a few things is that, back to earlier, inflation, talk of recessions, that kind of stuff. I suppose a lot of that, the world, or the governments, I suppose, or the analysts kind of know, will we not on hit recessions or not, and some already been recessions. Where that technical thing happens, the share market's already priced that in. So as if they're going, by the way, we're in a recession, the share market's not going to fall by 20%, I wouldn't think.
Well, I think this is that's an assumption a lot of people make, that the markets are pricing in all future scenarios. And don't forget, it wasn't even that long ago when people were still pricing in a severe recession.
Mm-hmm.
Our expectation now is that if there is going to be a recession, it might be more mathematical than actually technical.
Yeah.
It'll be more technical than it will be actually like severe. It seems that the biggest thing you have to remember is when you look at how recessions are defined or observed, the biggest indicator that tells you you're in a recession is you have rapidly rising unemployment. We're not even close to that right now. And in fact, there are certain labor conditions are so strong in some parts of the world that people are going on strike, right? You don't go on strike unless you feel incredibly secure about your job.
Yeah.
And so, again, we do acknowledge that we are late cycle. We're definitely at the back half of this cycle, but the length of this part of the cycle could be quite extended, and it may not be that severe. So, again, our view is that there may be a slowdown coming. Now, whether that translate into an all-out recession when people are thinking about like job losses and a severe credit cycle, that seems very unlikely to us.
Yeah. From your position and your responsibilities with Lonsec, I suppose, how are you positioning portfolios or seeing portfolios in terms of kind of overweight sectors or underweights? I'm guessing we're still invested across the board, because even though cash is attractive, with inflation we need to be invested in growth assets. So are there any particular insights, and a lot of our clients are in Lonsec portfolios, in terms of insights about how you guys are positioning given what's coming up?
You're exactly right. Being fully invested is something that we always promote. Simple number, you got 6% inflation, you're getting 4 or 5% on a TD, you're still got negative real returns. You're going backwards, right? So cash is a place that you hide in very, very short term, but it's not it's not a long-term strategy. It does not make sense long term. So we're completely aligned there. In terms of how we're thinking about the portfolios, I'll be very frank with you, we're quite neutral, right? Across the board, across all our different asset classes, given that inflation is a bit of an open question, given the robustness of earnings, when in doubt, our view is that you lean on your strategic asset allocation to carry the day. As we know, your SAA, a lot of statistics are out there, generate around 90% of you, can explain about 90% of the returns from your portfolio. We don't have a lot of conviction in terms of when will the RBA cut rates? When will we see inflation come back? Where will iron ore prices be in 6 months' time? So in this scenario, we're actually not being too aggressive in terms of where overweight, underweights are right now. We do acknowledge that we still feel that the US market does look quite expensive. But again, when you delve deeper into it, it's really a tale of two cities. You've got the Magnificent Seven that are really driving the market higher, and legitimately so, because you're seeing earnings growth with the Magnificent Seven of around 44%. ROEs that are 30% higher than the rest of the market, they should be going
Yeah.
higher, right? Versus the rest of it. So
Being
there's
priced appropriately.
you need
Yeah.
to actually get quite clinical and actually quite tactical when you start looking at markets, right? Even here in Australia, right? There's a very, very big difference between owning, say, a bank versus a miner, given these different outlooks,
Yeah.
right? So I would just be very mindful that given that the currents right now are particularly challenging, because we do have to acknowledge we are slowing down. In a slowing macroeconomic environment, growth assets, you may not want to be going too aggressive against that. And so we're just, our message to investors right now is lean on your SAA, but still stay fully invested.
Thank you for your time. Thanks for your insights.
Thank you.
Thanks, Nathan.
See you soon.
See you, mate.